Welcome to this monthly market outlook call, which is coming at a very, very crucial time. There are so many uncertainties in the world. We have tried to gather charts and data so that you can take a right decision. This market reminds one of a kangaroo market. One day it is up when President Trump announces positive thing about war, and it becomes a bear market when President Trump announces something negative on the war. The tariff uncertainty continues to hound global economy, albeit at a lower level than what it was before. If tariff was not good enough, we got hit by US, Israel, and Iran conflict. As expected, global equity market corrected. US 10-year yield went up. Crude oil went up and now is trading in triple digit. Surprisingly, gold remained flat as rising US interest rates put pressure on gold prices. Oil is the base material and feedstock for many chemicals, plastic chemicals, their derivatives, and the entire value chain gets impacted by oil. It is fabric of our daily life. The Strait of Hormuz matters because large percentage of global oil and gas supply transits via the Strait of Hormuz. It's almost 26% of global trade of oil and gas which transits via Strait of Hormuz. The number of vessels which are crossing Hormuz Strait has come to a halt as Iran has repeatedly threatened movement with drone and missiles attack. It's not just crude oil, but also LPG and LNG tankers whose movements have been shut. Could there be alternative? Yes, 45 years ago, Saudi Arabia built a pipeline so that their oil could move from Red Sea rather than Strait of Hormuz. UAE also built a partial pipeline crossing Strait of Hormuz, but they can provide partial solution and at a higher cost compared to free flow in Strait of Hormuz. The direct impact of shutdown of Strait of Hormuz, well, the freight rate went up not only for ships stranded in the strait, but also all over the world. And insurance premium also went up for the freight liners. As oil prices went up, inflation is expected to gather pace in the near term, which is why we saw interest rates going up. If inflation rises, supply chain gets disrupted, global growth will slow down. Undoubtedly, we expect global real GDP growth to revise downwards in the days to come. As inflation rises and growth slows down, central banks will focus on managing inflation rather than supporting growth. Anyway, they had already fired the bullet of interest rate cuts through easy monetary policy. Now that will dwindle further. If that tariff and US Iran Israel conflict was not sufficient, we are also facing challenges on Japanese carry trade. Interest rates in Japan has gone up, and that's bound to reverse yen carry trade, taking out capital from many parts of the world. If yen carry trade was not sufficient, there are people who are believing that we may see subprime crisis of 2008 US getting repeated. Many private credit funds of giants like BlackRock, JP Morgan are restricting redemption because of lower liquidity in private credit. Will it become subprime? Time will tell, but we are watching the situation. If all this was not good enough, we also got a jolt on crypto. Crypto prices have come down in last couple of months, and that has hit wealth by about $2 trillion. Put together, we are witnessing a perfect storm: tariff, Middle East concept, crypto meltdown, private credit market meltdown, and yen carry trade reversal put together. If Middle East the only geopolitical risk? Well, look at this chart. The US imports from Taiwan is now crossing US imports from China. Will China do something? Who knows? So world is facing certain peculiar challenges in current situation. If we look at Chinese economy, their fiscal stimulus remains high. Government is running deficit to fund growth. They have pivoted from real estate to industry by providing sufficient bank credit. Banks earlier were lending to real estate industry. Suddenly, they pivoted to lending to manufacturing industry, making China world's largest manufacturer. The results are impressive. China is global leader in many industry. Automobile is one particular exceptional. From nowhere, China emerged as the world's largest exporter of automobiles, and today it sells more electric vehicles in China than what America sells in its domestic market of both ICE and electric vehicles. China is not resting on laurels. It is planning for future. They are the first country to cross 10 terawatt of power capacity, and they have 39 nuclear reactors under construction. China is less impacted by US trade war. Their exports to US has come down, as we saw in the previous slide, but their exports to other parts of the world have increased, and hence it has crossed $1 trillion in exports revenue. Unlike many other countries, China's oil imports are highly diversified. They have been the largest importer of Russian energy. They have been also largest importer of Iran. And surprisingly, Iran is exporting more oil now than before the conflict began. This highly diversified oil supply of China gives their economy some sort of safety valve. China slower growth or problem started when real estate industry corrected. Investors had bought real estate in expectation of return. Falling real estate prices, stalled real estate took those aspirations away. Prices corrected, creating a vicious cycle. Now it looks like Chinese real estate market is stabilizing. Despite impressive economic performance, Chinese stock market has started underperforming global market from September, October onwards. When this underperformance was moving forward, we did see in the month of February, FPIs turning buyers in India. If you remember, couple of months ago, we had mentioned FPIs could be buyers in India if we are lucky. One, we want investors to take money out of US because dollar is weakening. And second, Chinese market should not do well so that part of that money can come to India. February did provided us that we were right. Unfortunately, March geopolitical tension changed everything. One of the reasons why Chinese stocks are underperforming could be because capacity utilization have come down, adversely impacting profitability. For us, critical things remain: the Chinese stock market doesn't outperform Indian market, that could result into FPI inflows into India. Time will tell whether that happens or not. US economy GDP is up 58% in last 5 years. From COVID knockdown, US has done impressive recovery. However, that recovery is debt driven. US debt is now bigger than GDP at $39 trillion. This debt burden is increasing as US government runs large fiscal deficit, and the war on Iran is also going to have increase in the deficit as lot of money spends in arms and ammunition. As debt burden rises, so does interest rate, and now US is spending about 5% of GDP for its debt obligation. As oil prices go higher, and Americans are one of the largest consumer as well as producer of oil in the world, it pinches the retailer's pocket, it pinches consumers' pocket. After blockbuster third quarter GDP growth of 4.4%, the fourth quarter GDP growth moderated at about 1.4% for December 25. To some extent, growth is supported by AI capex. All the Mac 7 companies, Google, Microsoft, Apple, are talking about hundreds of billions of dollars of investment in AI capex that supported growth. This Mac 7 companies, despite spending so much money, is relatively in better financial shape. They are not heavily leveraged, they are not loss making, and their valuations are still reasonable compared to 2000 tech bubble. We believe this AI capex trend is likely to continue and be supportive of US GDP growth in quarters to come. One of the worry for AI is impact on jobs. And even in mighty US, we are seeing that entry level jobs are getting impacted little bit. It's not a significant impact yet, but it does have some impact, some adverse impact. This job losses are coming at a time when inequality is rising in US. Post COVID, the gap between top 10% of American consumers versus bottom 80% is widening significantly. Many Americans are opposing war in Iran. Put all these things together, US dollar is weakening since 2025 beginning, while it seems to be stabilizing in a range post mid 2025. But continuity of war, rising interest rates, and policy uncertainty could result into further weakening. Coming to Indian economy, headlines by and large were positive in Feb and by and large turned negative post conflict began. LPG gas cylinder, whether there is real shortage or holding, who knows? But certainly headlines have started turning negative. Higher oil prices are like Rahu Kal in our economic kundli. It increases inflation, it reduces GDP growth, it widens current account deficit, it depreciates rupee, it impacts equity market sentiment, it results into higher fiscal deficit, potentially impacting interest rate. Essentially, oil is Rahu Kalam of Indian Kundali. Middle East accounts for 55% of India's oil import, and India is the third largest importer of oil in the world. To some extent, we are buying Russian crude to replace Middle Eastern crude, but undoubtedly there will be some impact on availability of crude and gas. This is the analysis of impact on economic parameters based on $10 increase in oil. CAD widens by 36 basis points. Inflation, including primary and secondary impact, goes up by 35 to 40 basis points. And GDP comes down by 20 to 25 basis points. Obviously, this is $10 increase for full year. Hopefully, this conflict will be limited and oil prices will not probably go down to $60 handle, but should stabilize in double-digit handle of 70 or 80 rather than triple-digit handle of 100. The historical evidence are clear. Higher crude prices are Rahu Kalam for Indian economy. It impacts GDP growth adversely. Over last 2 decades, oil sensitivity of Indian economy has declined as we have focused on renewable power, as we have focused on energy efficiency through LED lighting equivalent. Obviously, what matters is the length as well as severity of conflict. Today, two Indian vessels or India-bound vessels carrying cargo were permitted to pass Hormuz Strait. If more India-bound ships are permitted to come, that will be very positive. Coming to other side of the economy, credit growth has started picking up, but banks' ability to lend money is getting restricted because of higher credit deposit ratio. The credit deposit ratio is running at 82% against historical average of 75%. Banks generally keep about 24% between CRR and SLR against statutory requirement of about 21%, and about 6-7% will be their infrastructure cost. 24 plus 6, 30, 30 plus 82, 112. That's the bank's balance sheet. Now, to lend incremental money, incremental credit, they have to create incremental deposit. India is running large current account deficit, and other emerging market runs large current account surplus. With higher oil prices, our current account deficit widens and puts pressure on all economic macros. While our manufacturing exports have started picking up from FY 21-22, they have started stagnating over 23, 24, 25, including this year. Services exports have been bright spot. They have been growing courtesy global capability centers. The services PMI remains at 58.5. This is reasonably in expansionary mode. Rupee is under pressure as RBI is short forward by 60 to 70 billion dollar. That short forward position, along with US-Iran conflict, is putting pressure on the rupee. Rupee has been behaving quite volatile. RBI intervention and supports pulls it back, but thereafter it again starts correcting. Last year rains were good. Water reservoir levels were high. Water levels in reservoir were high, and hence Rabi crop saw a bumper output. Now all eyes are on El Nino. The omens are not good. El Nino probability is increasing. We'll come to know of details in May. We believe at current rate of acceleration, El Nino is likely to hit August, September rain and not June, July rain. If that happens, impact of El Nino on monsoon and rural economy will be limited. Let's wait till May to get final confirmation. The other challenge for Indian economy is AI. It's impacting jobs at entry level in IT industry. AI could severely impact both revenue and margin of IT industry. Most Indian IT stocks have corrected in anticipation of such behavior. IT market cap share now is below its profit share in listed corporate India. They are now getting valued at lower than market average. Artificial intelligence is writing programs, creating plugins, and market consensus seems to be valuing AI at much higher valuation than IT services company. Why does this matter to us? It matters to us because about 4 crore Indians, directly or indirectly, work in BPO, KPO, GCC, and IT services. With remittance and revenue, they earn $350 billion annually. If those jobs go down, car purchase, house purchase, bank, retail loan repayment, everything will come under cloud. Undoubtedly, IT is an opportunity of lifetime or risk of a lifetime. Subject to IT behaving, we believe rest of the Indian economy, despite current oil challenge, is reasonably in good shape. We will, on an incremental basis, deliver about one-fifth of global GDP on a purchasing power parity basis in next 5 years. Our share will touch high single digit as percentage of global GDP in next 5 years. Our equity market also corrected in view of geopolitical tension. Our market cap to GDP ratio is high, anticipating strong economic fundamentals and also anticipating that the impact of war will be minimal or short term in nature. The broad markets are down just under 10%, but mid cap and small cap and micro cap has seen much significant erosion. We have managed our schemes conservatively, and compared to market fall bearing small cap fund, we have been able to outperform benchmark index. The small cap fund has underperformed peers and index because of two limitations. One, Kotak Group owns 15% in MCX. Under SEBI RBI regulation, Kotak Mutual Fund cannot buy MCX. That stock is up 7 times in last 3 years. And inability to invest in MCX resulted into underperformance of Kotak Small Cap Fund. Second, our permission to invest more than 5% in 5 banks is in consideration of the Reserve Bank of India. That permission is little bit delayed, and that also adversely impacted performance. If I adjust Kotak small cap performance for its statutory limitation to invest in MCX and some of the banks, then it's a reasonable performance in the middle, certainly not at the top, but certainly not at the bottom also. The December 2025 quarterly results witnessed Nifty 50 company to deliver about 7% profit growth in line with expectation. In that, small cap profit growth came at 19%, mid cap came at about 9%, and large cap came at about 11%, almost in line with expectation. Overall PAT as a percentage of GDP is running at about 5.3%. It's difficult to estimate if it can further increase from here meaningfully, which means earnings growth will be in line with nominal GDP growth, give and take 5-10% here or there. While FY26 profit growth will be impacted by oil and Middle Eastern conflict, if it is temporary in nature, then FY27 as well as FY28 earnings could see double-digit growth led by banking, cement, and automobiles. Over last 1 year, Indian markets have delivered return comparable to China, but it is significantly lower comparable to countries like Korea, Taiwan, Mexico, Brazil, and host of emerging market. This resulted in India. FPIs were also seller of IT sector. Their focus was selling expensive in consumer sector as well as some profit booking in healthcare and real estate. They continued to add in media and telecom, capital goods, and metals and mining. India's share in global market cap eases from September 24 when Nifty touched 26,000 as other markets outperform, and our market is almost similar to where it is. यहाँ से ले लो, ये पूरा भरा पड़ा है, यहाँ से ले लो. FIIs, as I mentioned earlier, turned buyer in February 26. Unfortunately, geopolitical conflict ensured that March they have been selling. Can FPI turn buyer in rest of the year? Well, that's not the base case. Base case remains that FPIs will be sellers, but with lower intensity. If they sold $20 billion in calendar year 2025, in CY26, they may sell 10, 11, $12 billion, not $20 billion. Why do we believe? We believe passive FPI could turn buyer as emerging market starts receiving flows, provided the conflict is temporary. The primary issuances do get FPI support. The selling by companies like Hyundai, Whirlpool, LG, Prudential will continue, and some of the profit booking by active FPIs in secondary market also will continue. But increased STT will reduce HFT selling. Net our base case, FPI selling should come down in intensity from $20 billion to maybe 10, 11, $12 billion. If we are lucky, an American dollar depreciates, investors withdraw money from America, and Chinese market doesn't do well, then India should get FPI positive flows. We have seen a lot of news on AI impacting IT services company. At one point of time, on 22nd of February, IBM stock corrected, one of the highest in its history, when Anthropic announced plugins and COBOL reading tool. Despite Middle Eastern conflict, IBM has recovered all the losses as investors realize that such tools were used by IBM many months back, many quarters back. This is the power of narrative, and this is also the power of research. Based on Anthropic announcement, speculators sold, and people who knew IBM's strength bought. And today, speculators are losing money and investors are laughing their way home. Thanks to all of your support, domestic institutional investors has continued to buy all throughout the upheaval. For last 18 months, we haven't delivered positive return in equity, and yet flows have continued showing confidence of the investors and work of mutual fund distributors. We haven't got as much credit for this spectacular participation. I hope one day government and regulators realize great work done by mutual fund distributors in hand-holding customers through turbulent time. Today, thanks to the correction, We are trading around historical average valuation for large and mid cap. In small cap, they are trading at premium to historical average. Our funds continue to add value by generating alpha, except in small cap fund and mid cap fund for the reasons I talked about. MCX and banks, the better performing part of both small and mid cap indices, we have not been able to add as much as we would have loved to add, and which is why there is some amount of underperformance. How will market behave? Well, जो लोग डॉन को समझ पाएंगे वही डिसाइड कर पाएंगे मार्केट कैसे बिहेव करेगा. फॉर ऑर्डिनरी फॉक्स लाइक अस, डॉन को समझना मुश्किल ही नहीं, नामुमकिन भी है. प्रेसिडेंट ट्रम्प, जियोपॉलिटिकल वॉर, tariff announcements, private credit market upheaval, yen carry trade reversal, China Taiwan equation, all those things will continue to impact our economy. On top of it, we have monsoon and oil to worry about. What we can tell investors, these are turbulent times. Market knows all these risks, and yet they are standing where they are standing. Please follow your dharma of asset allocation. Don't look to invest in lump sum. Please invest on a staggered basis because there will be volatility. But this is the time to invest rather than redeem. If your assumption is that this war is temporary and will not get prolonged like Russia Ukraine, our belief is that Israel, US will not put their boots on the ground in Iran. Iran is a large country with 9 crore people. Unlikely they can be invaded like Vietnam, like Afghanistan, like Iraq. And hence this war will be temporary in nature. Over last 6 years, stocks have delivered good return. Almost 300 stocks have doubled despite correction in last 6 years. 168 stocks are trading above 50 P, and hence it is important to invest keeping in mind valuation. Buy at any price may not work in today's volatile scenario. Last 6 years return for broad market is about 14.5%, led by mid cap of 22% and small cap of 18%. But before that, for 15 years, market return was about 11%, driven mainly by large and mid cap. Overall return for last 21 years is 12%, led by mid cap at 14, large cap at 12, and small cap at about 11. It is extremely important for us to moderate our customers' return expectation. Everyone is expecting 20% return. That may not come in 1 year. It may require 2 years waiting to get that kind of return. If we can manage our customers' return expectation, job will be done. They will stay invested through the upheaval and they will be satisfied. Our outlook at this point of time, overweight large cap, marginally overweight mid cap, and underweight small cap. If you are looking to do STP in small cap, you can probably begin, because while we made this call on 28th of Feb, it's changing every day. And who knows, in the month of April, we could give buy call on small cap. So the margin of small cap underweight should be bare minimal as corrections are happening at a faster pace. On the equity investment opportunity, our funds on a rolling return basis continue to generate outperformance over benchmark index across equity fund as well as across hybrid and equity funds. On a point-to-point basis, bearing small cap and mid cap for the reasons I explained, we have been able to outperform benchmark indices across our equity funds and even on SIP performance. By and large, we have been able to outperform benchmark indices across majority of funds in equity as well as in hybrid funds. Kotak Flexi Cap Fund managed by Harsha for last more than 15 years is now one of the best performing fund. It has gone through its own ups and downs, but please remember at 56,000 crore AUM, it is a oil tanker. It's not a speedboat which can take U-turn quickly. And Harsha has managed the scheme with really disciplined investment process. Over the years, it has delivered returns to meet investors' expectation. And do consider this as part of your core customer portfolio. They will not be disappointed. Multi-asset allocation is the way forward. For large HNI clients, you can do asset allocation on your own. But for retail customer, multi-asset allocation is the way forward. Outside of equity, there are opportunities in debt and precious metal and REIT and InvIT and exchange traded commodity derivatives. Hence, investing in multi-asset allocation fund will be appropriate. We took overweight gold call from 2020 COVID time. It worked well for us. We took overweight call in silver in April 25. That worked well for us. And Kotak Multi-Asset Allocation Fund today is one of the better performing fund among the peer group. Kotak Multi-Cap Fund invests across large, mid and small. It has outperformed its benchmark indices. On passive side, we continue to manage across broad portfolio of large cap fund, mid cap fund, small cap fund, smart beta fund, as well as gold silver fund. Across majority of our passive funds, we will be one of the lowest expense ratio fund. And in such funds, returns are largely driven by expense ratios. So lower expense should result into better return. Our bucket of passive fund includes various sector and thematic as well as offshore fund. Unfortunately, in offshore, we don't have open limits. These are some of the passive funds which you can consider for your client allocation. We remain bullish, large and mid cap, and both gold and silver. Sectorally, consumption and banking can be looked at. Coming to debt market, US inflation is stagnating but should start moving up as oil prices come into play. Fed futures are expected to come, Fed rates are expected to come down by 1 to 2, sorry, US Fed is expected to cut policy rates by 1 or 2 times as per Fed futures indication. At one point of time, they were looking at 3 to 4 rate cuts. Now they have come down to 1 to 2 rate cuts, essentially because of the oil, oil price going up. Next slide, please. India's CPI inflation has continued to remain benign, but with oil and gas prices going up and impacting other parts of economy, inflation should start inching up. Rupee will remain under pressure as deficit widens because of higher oil prices. And more importantly, RBI short forward position continues to weigh rupee level. RBI has been playing like Shivam Dubey or Abhishek Sharma in providing liquidity. They are doing open market operation where they buy government securities from market participants and give cash. They are buying in secondary market on NDS OMS platform. They are doing dollar rupee buy sell swap to pump liquidity. They have also cut CRR proactively. Essentially, RBI is managing liquidity to ensure growth doesn't get adversely impacted. Overall liquidity is in reasonably good shape, even though interest rates have started going up because of the fear of higher deficit and higher government supply. FX intervention will require liquidity infusion by the RBI. So far, they have done a reasonably balancing job. The worry is how much of oil price hike will be passed to consumers and how much of oil price hike will be absorbed by government in fiscal deficit. If government absorbs this pressure in fiscal deficit, supply of government securities to fund deficit will increase and put pressure on interest rate. On the debt investment side, shorter end of the curve, money market fund, arbitrage fund will be appropriate. If you are looking to invest for a longer term, then income plus arbitrage omni fund of fund will be appropriate, as after 2 years, the taxation rate for gains on income plus arbitrage omni fund of fund will be 12.5%, substantially lower than what you will pay in other comparable fixed income options. Gold is now consolidating after big rally in 2025. As I mentioned, our multi-asset allocation fund invested in gold right from COVID days. And in April 25, we invested in silver. Despite recent correction, both this commodity has delivered still double-digit return in 2026 first 2 months. Central banks of the world continue to buy gold. Polish central bank now has almost 50% of its local currency by way of gold investment. Thanks to central bank buying, people are expecting gold demand to remain higher, and it should move from about 5,500 tons to about 6,000 tons this year. Gold prices have witnessed spikes and consolidation throughout the history. We are witnessing one of the biggest spike in its history. Hopefully, after some consolidation, it could move to next level. China continues to be important player in gold market. Sometimes they also do unofficial buying, selling, and hence their activity will continue to have impact on gold prices. The good or bad part of gold, there is no new mines which are coming on stream. New silver mines have come up on stream in Argentina, Peru, Mexico, but very few new gold mines have been discovered or coming up on stream, and hence supply side of gold remains restricted. The silver price chart has witnessed sharp volatility. Can't really live without volatility in silver. This volatility should continue. Indian silver imports are at record high, and clearly we are one of the largest buyer of gold and silver in the world. Our buying along with central bank buying will continue to have impact on gold prices and silver prices. This is repeat of the last month's or last couple of months slide. You are well aware about our positive view on gold, silver, but you need to cap it as a percentage of your portfolio because of the inherent nature of gold and silver. Next slide, please. If I have to summarize, we are living in an uncertain world. Global growth will get impacted. But rate cuts will get lesser and lesser because of rising inflation, and geopolitical volatility will continue to impact market. In debt, focus on the short end of the curve, focus on performing credit AIF kind of product. In gold, silver, view remains positive for long term, but one has to be very cautious to invest into because there will be higher volatility. And please put a cap as a percentage of your portfolio. Equity volatility will increase, returns will moderate, but if FPIs come, we could have a Goldilocks, higher return, lower volatility. Large and mid cap looks better vis-a-vis small caps, but we can change our view next month as small caps have corrected in first 12 days of this month. Sectorally, consumer, cement, private bank should outperform, and chemical could provide opportunity to enter over next 6-12 months, and then the upcycle could start. This is how broadly we see the market. There is tremendous uncertainty because of geopolitics as well as local. For us, bigger concerns remains AI and IT services industry. Undoubtedly, we'll have to manage this volatility. Following dharma of asset allocation will be most important. Take a printout of this two particular slide and keep it with you. This shows what is our equity call, what is our gold silver call, and what is the ideal allocation between equity, gold, silver, and debt. This is something which you should observe on a monthly basis. Next slide, please. This is our sectoral call: overweight large cap, sorry, overweight mid cap, equal weight large cap, and slightly underweight small cap. Equity wise neutral, gold overweight, silver overweight, and sectorally auto, healthcare, cement, banking, financial services, and consumer. And the focus product is multi asset allocation, multi cap, and flexi cap.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.